Sydney just had its worst auction weekend in years, and if you own a place you're looking to buy or you work anywhere around property, construction, or lending, this actually matters to you. The interesting part is there are two different things hitting the housing market at the same time, but most people only notice the headline about prices. They miss what's happening underneath, and that's usually the part that tells you where the market could be heading next. The reality is, nobody knows yet whether this turns into a proper multi-year correction or whether it's just a short-term slowdown, because that still depends on decisions and economic data that haven't played out yet. See, that's usually how property cycles work in Australia. It's never one massive headline that changes everything overnight. It's little things that most people don't pay much attention to: a clearance rate quietly dropping below 50%, a policy announcement buried in the budget, or banks tightening lending in the background. Then 6 months later people go to sell their place and suddenly realize buyers have way more negotiating power than they expected. No one sends you a message saying, "Hey mate, the market's changed." You normally figure it out halfway through buying or selling, so here's what we're going to look at. First, what's actually pushing borrowing costs up, and why auction clearance rates have fallen this much. Then we'll clear up all the confusion around the recent property tax changes, because there's a lot of mixed information floating around. And finally, we'll talk about what all of this actually means, whether you're buying your first home, already own property, or you're investing. By the end, you'll have a much clearer idea of whether this looks like a temporary slowdown or something that could stick around for a while. Quick disclaimer before we jump in: I'm not a financial advisor, this isn't personal financial advice, and everyone's situation is different. Think of this as a conversation to help you understand what's happening, then have the detailed version with your broker or financial advisor who knows your personal circumstances. Let's start with borrowing costs, because honestly that's where most of this story begins. After a long stretch of interest rate increases, borrowing money is still a lot more expensive than it was during those ultra-low rate years Australians got used to through the pandemic. And that's had a pretty direct effect. Higher repayments mean people can't borrow as much, and when buyers can't borrow as much, fewer of them are competing at auctions. That's why Sydney and Melbourne have seen clearance rates fall into the high 40s and low 50s recently, the weakest run we've seen since 2020. Now here's the important bit. That doesn't automatically mean things keep getting worse from here. Interest rates are reviewed regularly, inflation is still the big driver, and plenty of economists think we might be getting close to the top of this rate cycle. But at the same time, nobody can say that's guaranteed, because it all depends on the economic data that's still coming out over the next few months. One thing people often get wrong is thinking a slowdown automatically means a crash. They're not the same thing. Clearance rates sitting below 50% don't mean house prices are falling everywhere. What it really tells you is sellers don't have as much bargaining power as they did a year or two ago, and buyers have picked up a bit more leverage. That's pretty much it. And when you look across the country, it's not even one story. Perth, Adelaide, and Brisbane are still seeing growth, just at a slower pace, while Sydney and Melbourne are the markets doing most of the heavy lifting on the downside. So this is really more of a story about the expensive, rate-sensitive markets than the whole country falling apart. If you've already got a pre-approval from a few months ago, it's probably worth checking whether that borrowing amount still stacks up today, because repayments have changed quite a bit. Now let's talk about the tax side, because this is where there's been a lot of confusion. You've probably heard people saying negative gearing has been scrapped, while others are saying nothing's changed at all. The truth sits somewhere in the middle. This year's federal budget introduced real, legislated changes to negative gearing and capital gains tax, but they're not retrospective. If you already owned your investment property before budget night in May, those existing properties stay under the old rules. They're grandfathered. The changes mainly affect new purchases of established properties going forward, with negative gearing being phased out from mid-2027, while new builds keep the concession to encourage more housing supply. So it's not a shock that suddenly hits every investor overnight. It's more like a gradual shift that's likely to influence where investors choose to put their money over the next couple of years. If you're investing, the important question isn't what you bought a few years ago. It's how the next property you buy will be treated under the new rules. And if you're a first-home buyer, fewer investors competing for established homes could actually work in your favor. When you zoom out though, both of these stories come back to the same issue, and it's probably the biggest one over the long term: housing supply. Australia simply hasn't been building enough homes to keep up with population growth. Even if governments agree something needs to change, fixing that gap isn't quick. It takes years to plan developments, approve projects, and actually build enough homes. That's why even during a market slowdown, areas with limited housing supply can still see prices and rents stay relatively strong. So even if demand softens because rates stay higher for longer, it doesn't automatically mean property suddenly becomes cheap. In a lot of places, it could just mean the market pauses before supply shortages start pushing prices higher again, and that's really the bigger picture. The market didn't suddenly change because of one dramatic headline. It changed because interest rates kept climbing, lending became tighter, and a few important policy changes slipped through that most people didn't pay much attention to. The people who take the time to understand those changes usually make better decisions, while everyone else ends up reacting after the market has already moved. So to wrap it all up, borrowing costs are still the biggest reason auction clearance rates have dropped in Sydney and Melbourne, although where rates go next is still an open question. The changes to negative gearing and capital gains tax are real, but they're being phased in gradually and existing owners remain protected under the old rules. And sitting underneath both of those stories is Australia's ongoing housing shortage, which is likely to keep supporting prices and rents over the longer term even if the market stays soft for a while. At the end of the day, nobody knows in real time whether they're looking at the bottom of the market or just a pause before another leg down. That's something we only ever know looking back. Usually by then, people are either wishing they'd acted sooner or they're glad they waited. If you've got a mate who's trying to buy in Sydney or Melbourne, or someone who's investing and still isn't sure what these new rules actually mean, send this video their way because understanding what's really changed could make a big difference over the next few years. And I'm curious, what do you reckon? Do you think we're heading into a longer correction or does the market bounce back once interest rates start coming down? Let me know your thoughts in the comments.